Hello and welcome to this week's Market Matters video update. So Friday the 18th of February today, James. We're right in the thick of reporting season at the moment. Plenty of companies, I think this is the big week of reporting this week. Sort of from a top level view, how have you found reporting for the ASX this period so far?
Yeah, it's been a busy week, Harry, hence why we're doing a video on Friday instead of doing our normal video on a Wednesday. So, top level reporting, I looked through, there's been some large companies that have reported this week. On the whole, I think it's been pretty good. So, obviously, we've had a raft of companies from different sectors experiencing different headwinds, tailwinds, etc. But overall, I think one of the key things that have caught my eye is the ability or the willingness of companies to issue guidance. Going into this reporting season, a lot of companies, it was our fear that given the uncertainties around the economy, the lockdowns and the like, there was going to be a reluctance to issue guidance. That hasn't proved the case. So that shows a level of confidence in the underlying economy, underlying earnings, and the visibility on their business. So overall, I'm going to say that this week's been a good week. There's been some hits and misses, as there always is, but overall, I think it's been positive.
One of those sectors that we want to focus on today is property. We're in a big office block in the city. I've noticed a few more people milling around the office this week. Number of companies reporting the last week or so. Dexus was pretty decent. We've had Abacus in this morning chatting to the management team of those guys. In terms of property, what have we learned from this reporting period?
You're exactly right. So we're in Chifley Tower, smack in the Sydney CBD. A lot more bodies coming into the office now. A lot more, more numbers down in the reception, in lifts, etc. So the city is coming back to life, and I think that is supported by what we've heard from a number of the property companies this week. So you made mention of Dexus. They're the biggest office landlord in the country. They've got very high occupancy levels, very high rental collection levels. So all in all, they were better than feared. We used to own Dexus in our income portfolio. We have sold out of it a while ago at slightly higher levels, but what they said was encouraging. Abacus, we had Stephen Sewell in from Abacus this morning. That was a really interesting take on they've got self-storage assets, they've got office, and they've got a bit of retail. In the self-storage space, they were talking up huge, very favourably that market. They're seeing huge growth in self-storage. We, of course, own National Storage in our income portfolio, not Abacus. We have owned Abacus in the past. I think it's a really strong company. But if you want that exposure to self-storage, then National Storage is the number one player in the space. So, and the other property companies, Goodman, which we own in our flagship growth portfolio, they've increased their guidance for 20% growth for the year. All in all, I sit back and think about what I've learned about property this week. It's better than feared, and I think that's been a case across many parts of the Australian economy. Vicinity, which is another company that reported this week in the property space, their supermarkets, retail malls, they did better. They're having better negotiations with tenants about rents, signing new tenants, plus the increase in rents they're going to push through to existing and new tenants is positive. So all in all, I thought, come away this week saying the Australian economy is probably in better shape than I feared. There's still some supply chain issues, which we saw with Wesfarmers, but overall I'm positive, Harry.
People need the space still. Some big movers in our portfolio today, particularly the income portfolio. Smart Group is having a cracker. It was up 10%. You called it before the market said 10%. I think it got there just. Magellan as well, which has been an underperformer but doing well on the back of that. Can you talk us through just some high-level points of these two results?
Yeah, I've written in the past that Smart Group's a company that I've bought from my grandma, and that sort of describes it. It's cheap. It's not, it's a good quality company. Pays a really attractive dividend yield. Is inexpensive and has got some reasonable, mid-single digit growth going forward. They've got a really tip-top balance sheet. They carry no debt, etc. So today they came out, basically reaffirmed the business is going well. They have announced a special dividend as well. So that's a stock yielding close to 10% on a PE of 13 times with reasonable growth going forward. So I really like that one, Smart Group. I'll just turn my phone off. In terms of Magellan today, they also they came out with their first half results results. There was nothing, the numbers were always going to be okay because they had a reasonable first half of the year. Funds under management stayed pretty resilient, so the loss of FUM wasn't fully captured in this half. They came out and did so that the earnings for the half were okay. They've come out and done something pretty interesting in terms of issuing. Well, they plan to issue options to shareholders on a 1-for-8 basis. So if you're a shareholder in Magellan, you'll get a free option with a strike price of $35 for the next 5 years, expiring in 5 years, I should say. So it gives you basically upside on the stock and a way of saying, come with us for the ride. We're going to rebuild this. They're doing the same for staff as a retention mechanism. So that stock was trading up 13% when we left the desk. So look, it's on its knees. These guys are smart. They'll turn it around, is what my view is around Magellan at the moment. So stick with it.
Definitely. In terms of the other portfolios, James, any interesting reports that you've seen come out in the stocks that you hold across the board?
Yeah, a bunch of interesting reports. I mean, last week we had Macquarie deliver some pretty good numbers. CSL this week has been the big one that's really rallied from lows. I mean, the market was pretty negative on CSL, so they've done well to allay some of those market concerns. They've banked 75% of the their annual EBIT, or the market's expectations around EBIT in the first half. They're saying first will be better than second half, but still they've banked a lot. In terms of the portfolios, I mean, if the backdrop in portfolios is large caps doing okay, mid caps, small caps doing pretty poorly. In terms of the market, if I look over the last 3 months, the large caps ASX 200's down 1%. The small ordinaries is down 7%. So it's been a pretty aggressive bear market in some of these small caps. Tough times happen in small caps and emerging companies. So hold your nerve. We've been through all the companies that we own. There's a couple we don't like. The majority we do. So we've sort of got to hold our nerve in that space. And then in the the international portfolios, the ETF portfolio is proving resilient, and the international portfolio, the tech's continuing to hurt a bit, but there's some really good moves, particularly in the energy stocks that we hold across portfolios in recent times. Gold is staying a copper bid, so no, reasonably comfortable, Harry. I say that probably most weeks, which is I'm a little bit uncomfortable with some of our small cap emerging companies at the moment, but we'll get through it.
Yeah, you touched on why the big caps giving guidance, which was a theme we didn't expect coming into reporting. It's not something we've seen down the chain. The smaller caps have been very reluctant to sort of hang their hat on some numbers for the rest of the year. So I think that's a lot to do with how that's underperformed in this reporting season. But for now, that's all for this video. Enjoy the weekend.
Bye for now.